Hello, everyone. We cannot see you, but I know that the webinar channel is popping up. Uh, let's do a very small introduction so everyone wraps up and joins us. I'm really happy to host the second edition of our Founders webinar series. It's been on our list for so long, and I think it's great to actually get up some cool people and discuss everything about investment, how to raise capital from interesting investors, what are the best practices, and so on. So today's theme is basically proven communication practices that drive investor conversion. And for this, we have today Robbin Hoogstraten, which is the country manager for the Netherlands. At SeedBlink, we have Alex Gavril, which is the CEO of Promocrat, growth marketing agency. And we also have Eoin, which is the leader for HubSpot for startups. Thank you.
Hi, everyone.
I propose that we basically have a small chat with each of you on specific themes that you already are very well known of. And then we can advance with some Q&A. So I advise everyone who is watching to address any questions, and obviously we will take them after we discuss. So I think we should start with Robbin. Hello, Robbin. Thank you so much for joining today. You have so much experience in investment and in crowd investing. And I think your point of view is very helpful for startup founders when it comes to understanding how investors think. So let's dive into this. What do you think is the typical research process that investors undergo when they are checking a startup investing opportunity?
Well, first of all, thanks for having me and inviting me, and thanks for the compliments. Always good to hear that I'm experienced, right? But yeah, from let's say this experience of doing this for over 14 years, I talked to indeed a lot of investors. And what's most important is that I would say that a lot of founders underestimate how deep investors will go once they are actually trying to learn a little bit more about you as a person, but also about your startup. So if you would, let's say, take a look at how an investor would do some, let's say, due diligence or some sanity checks, of course, it would vary by type of investor. So if you would look to more institutionalized investors like venture capital or family offices or corporate venture capital funds, they really want to do a firm due diligence. So they do not only search for things they can find themselves, but they really ask you for a lot of materials, and they will dive deep. They will go into your technology, they will go into your systems, your CRM, which happily we have somebody on board who can tell you a lot about CRM. But they will really, really dive deep, not only into what you show them, but also what you don't show them. If you're working with more private investors, then on the research end, of course, they start with the materials you will send them, and they form their opinion, and then they'll do their own research. And their research will be based upon checking you out, which means that they will do checks like, hey, where do you come from? What's the feedback about you? How are you rated on Google? Can they find any cases on fraud or any, let's say, keywords which people are searching for, bankruptcies, KYC, UBOs? Usually they dive quite deep in order to find out who you are. Also into your network, who are you connected to? Do you have, let's say, common connections? If there are common connections, you wouldn't be surprised that, or you should not be surprised if they would also reach out to your connections to validate. So yeah, they go quite deep. So you need to make sure that not only your materials are up to par, but also your online footprint is well structured. And if they go and search for you, that they find what you want them to find.
Thank you. So basically, it goes far beyond the fundraising marketing campaign, basically.
Yeah, yeah, definitely. It goes into your personal life as well because they want to know who you are and if you can succeed.
Definitely. Thank you. What do you think that are some common red flags that could actually deter them from investing in a startup, from your experience?
Well, this can be quite a lot, of course. Let's say the most basic ones are materially based, so that your materials are not up to speed, you are not able to communicate well what you're actually solving. So I see a lot of founders who actually solve what I would call, let's say, mosquito problems or micro problems, which they really created big in their minds and in their heads. But if you're really trying to see how big the market size is, then that can be well, a big showstopper. So there's not enough market size or people willing to pay for your solution. So that's more about let's say the opportunity and the upside of it. But maybe something less known might be that if you're, for instance, on LinkedIn and your profile shows that you're not only dedicated to your startup, but you're also a consultant at some sort of an advisory firm, then this might also be a red flag for some investors because they want to see full dedication. So they want to know that you can spend 200% of your time into your startup if they invest into your startup. And if they know that you're actually also having a base salary or something from another company, or you're, let's say, dispersing your, let's say, time and focus around different initiatives, this might be something they don't like at all. So that's also important to take into account.
Definitely. And I can also remember that we had some cases when we saw that founders might not be as invested as they said they were in the beginning. Yeah. From the investor's perspective, how important do you think that storytelling is in the communication strategy?
I think, of course, it's really important because with the storytelling, you really bring across, let's say, your mission, your vision, and everything you're going to do as a company. So you need to prepare a well-structured pitch. You need to show the, let's say, most important parts of the company, and you need to make sure that you're able to do this quite, let's say, diligently. So prepare your elevator pitch. Make sure that you're I like to say always be closing. So if you're at some sort of an event, always make sure that if they ask you to do a pitch, just do the pitch, practice, and do it as much as possible. So that's really important. At the other hand, I do think that it's not the most important part. Of course, you need to come across as trustworthy. You need to be an expert into your scene or your field, and they need to feel that you are. So they need to feel the trust of you as a person and the story. And then in the end, of course, they'll dive a little bit deeper than only the storytelling part because they will also, let's say, pin through some of your exaggeration, which you always have because it's also a bit of a sales pitch, right? And good investors might be able to see through that. So, for instance, if you are talking about P&L or cash flow, you're prognosing a 400K revenue for next year, then maybe you see the mind of the investor already calculating, okay, 400, let's divide by 3, and maybe we are close to reality. So you should understand they also use their own rationale to compare your story to. So never overestimate, I would say, let under promise, over perform, make it clear, not too shady, not too, let's say, big, just to the point.
But what if Underpromise is not sexy enough to to raise the investment round, huh?
Yeah, that's a
That's a
true
trap.
and known dilemma. Yeah. It's some sort of a balance, right? You don't want to be too cocky and really showing like, hey, I'm. And sorry if we have any Americans in the webinar, but like I'm the American entrepreneur promising the world, and then everybody will invest. So there's a trade-off here. Of course, you need to be ambitious and you need to show that you really can scale the company and that there's a large market. But you need to be realistic as well at the same time. So there's always a trade-off, and I think it also depends on the type of investor you're talking to. Try to do some research also if you're pitching to somebody. see what they did before, and then based upon their own experience and the kind of profile you're talking to, you can maybe also guesstimate if you should, let's say, pump up your pitch a bit, or let's say rationalize it a little bit more.
Awesome. Now we've talked a lot about communication, I don't know, pre-round or during the round, but I know that it plays a huge role also after the round is raised. What would you call for a good investor founder communication?
Well, I think it's really important that you don't only inform each other at the good times, but definitely also during the bad times. And this is something which is really underestimated, because you need to understand that if you're accepting investors into your cap table, that you're going into some sort of a marriage, right? And can you imagine not telling or talking to your wife or a guy, let's say for a long period in time, then usually there will be some fights. And this is the same with, let's say, investment. If you don't talk after the deal has been done and you don't inform each other about the progress, the hard things and the good things, then you can expect hard times. So I usually say it's even better to share the bad things opposed to the good things, because with the bad things, investors can jump in and they can help. And in terms of frequency, it's not like your stock listed or whatever, so you need to communicate every day. Not your info is not public, right? So it's a private round usually you're doing. So I would say once every quarter, prepare more of an extensive management summary guided by some KPIs. Use tooling for this, so you can also structure it, and yeah, make sure that you do regularly communicate, because upon that basis you can form this trust relationship to grow the company together.
Thank you. Amazing. And thank you for also getting in with the time slot. Great. Now let's switch to Eoin, who is the head of startups at HubSpot for startups. Now you've managed a lot of campaigns, and also you've overviewed basically the activity of HubSpot in a lot of European countries. So let's kick off. How can a CRM implementation help a startup from its early days?
Yeah, I think the interesting thing, and it kind of goes back to like what Robbin was saying also, is if I'm an investor and I see that you're using Excel, your pitch gets binned because Excel is not scalable, right? So I think the thing about it is when you look at what we're trying to achieve, and going back to Robin's point there, was we're trying to essentially share, sometimes overshare, sometimes undershare, sometimes. But what we're trying to do is we do want to have that very clear, open level of communication between an investor and between, our company and our prospects and so having a CRM, in my opinion, is a non-negotiable when it comes to building your startup, regardless of what stage you're in, because the more information that you have about your customers, the easier it is for you to paint that good story for your potential investors. If I know what my customers want, I know what they're interested in, I know what they're clicking on, what they're looking at, what actually makes them tick, that's when you can actually speak with authority on that space. If you use the expression, I think, you're already losing. And if you use I think has no data points. I know has data points. And a lot of the time when I listen to pitches or I get investor books and pitch decks, and I start seeing that the hypotheses are not actually linked to solid customer or prospect data, that's for me massive red flags. And the way you do that is essentially having a central source of truth, which is a CRM system. Whatever that CRM system is, just please have one. It will make your life easier when it comes to the scalability of the business. It also shows your investors that you are the real deal. To be brutally honest. And that's what they want to see. They want to see, okay, these guys are scalable. They know what our customers want. They understand where they're going, and they're able to paint this big, beautiful picture about the pain point that your customers have. And I say this in every workshop or session I've ever done, which is nobody cares about your product and your service other than you. What they actually care about is the pain point that you're solving. And if you don't have those data points to prove that hypothesis, you're essentially kind of shooting yourself in the foot a little bit. And that's what I consistently see when, I'm doing angel rounds, is that if someone gives me a pitch deck and I ask, my first question would be, okay, show me your CRM, show me what your data looks like. And they're like, oh, we're using Excel. Bin, straight away. And that's a problem, and it's really hard sometimes for founders to understand that, because they feel like they have the data, but it's not actually concrete based on real touch points of the customer journey. Long-winded answer, but hopefully that makes sense.
It does definitely. Sailing close to the wind here. And basically what you're saying is that you're seeding the seeds for growth for the long term, definitely.
100%.
How can startup efficiently manage the expectations from investors regarding updates?
Yeah, good point. And I think one of the things that is clear is open dialogue. And again, like what Robbin mentioned, positive negatives. Like what and when do you want to see data? So I'll give you an analogy, or maybe a brief story. Is my wife and I sat down at the start of the year and decided on what times we were having dinner and breakfast at, so that we can maximize our time with our daughter. That's in my calendar. I never miss those meetings. Nothing will be booked over them, right? But it's clear. We both know. My daughter knows, right? She might be only one, but she knows that she has dinner with mom and dad at X time, that she has breakfast at X time. Business is the same, especially with investors. So clear, open communication based on when do you want to see data, how frequently, how often, what data points do you want to see, and what format do you want to see that data points in. And that's clear, and it's very easy to ask those questions and get that information literally within seconds. And sometimes we feel awkward about asking those questions, but it's in your best interest as a founder to ask your investors those hard questions, and then build something that's automated to fit that need. So if they want to see a PDF every month on a Friday, the first Friday of every month, send it to them. Have it automated. Pull that information, send it to them. If you have a CRM, that's really easy to do. It's 2 clicks. If you're using Excel, that's probably going to take you 2 days to do it. So what I'm trying to get at here is, again, just make sure that you have things that can be automated. It will make that life easier, and ask those tough questions.
Definitely. Thank you for making such a strong point. I think it's invaluable. What strategies can startup use to maintain these relationships beyond the initial investment phase? Because I think it's really important.
Yeah, and again, I'll go back to Robbin's last point, which is just, again, make sure that the information is being consistently shared, good and bad. If you're having a bad month or your forecast is below target, let them know. I invested in a company a couple of years ago, and they still send me monthly newsletter with the cool things that they do within the company. I find it super interesting. Because they're literally telling me about the new customers that they signed last month, or it could be little basic things like we've added a new product line. Yes, I get that information quarterly at our kind of meetings, and yes, but I like it often. That's personally me. So what I would say is, again, that doesn't take a lot of work. It's an automated email, newsletter style email that goes out to your investors that just shares the good, the bad, and the ugly. Um, I'm a big believer in that, whether you do it as frequently as monthly, like that company I mentioned, or whether you do it quarterly. I just think it's nice to keep them in your community, because they invested in your idea because they could see a pain point, which means that the likelihood is they're actually interested in what you're trying to do and what you're building and what you're trying to, where in the market you're trying to help.
Robbin, you wanted to add something?
Yeah, I just also realized that we're talking now, of course, about the investors who are part of the company. But exactly what you're saying, Eoin, is also compliant to people who are prospective investors. And I've learned about a couple of companies who did this really, really well. They set up from their CRM a system let's say, investor leads. And what they did is on the bi-monthly basis or quarterly basis, or some do it on a monthly basis, they informed their investors with company updates, so regular company updates. So at certain milestones, the investors knew, like, hey, and now I am activated to actually participate. So you can also do this pre-investment to engage people. Also really, really nice to do something like that.
Yeah, I actually wanted to ask Owen if he's more keen to reinvest in them just because he received such a regular communication from their side.
So funny that you mentioned that. I actually did reinvest in them. So I invested pre-seed and I invested seed, and the basis of I love what they're doing, and I just find it so
Know
interesting
about
that
it.
it's a company called Riley. They do sustainable period products for women. And they have a very clear B2B, B2C model. And I love that they started B2C and I got it, subscription model. And then B2B, they went down a completely different route. And they're really heavy on large office spaces around Europe. And they're doing exceptionally well. And I just find it super interesting. I'm not their target investor at all, but I get what they're trying to achieve, and I just thought it was really clever. And I think that continuous open level of communication is what I personally like. Um, Now Robbin could be completely different. He mightn't like it, or so on and so forth. So I think the thing about it is figuring out what they want, and then going back to Robbin's point also around potential investors. Um, it gives, if you've got an investment consultant that's going to reach out to these people about their next round, it's a really easy conversation. Hey, I seen you opened my email. You watched our video on our latest update. That communication completely changed from being, hello, my name is Eoin from HubSpot, HubSpot, right? The cold completely changes. It goes from cold to maybe lukewarm or temperate. But that's a win because it makes it so much easier for that. I'm going to call them a salesperson, but that salesperson to be able to actually have a conversation rather than, explaining who you are, why you're calling, and do you have 5 minutes to talk to me today?
Definitely. Thank you so much. Really, really inspiring and insightful to see this perspective. Next, Alex, obviously from Promocrat. He's been the founder and CEO of this growth marketing agency in the past 10 years. And he has worked with a lot of tech startups, helping them grow their business or either, I don't know, launch on Product Hunt and so many other cool stuff. Happy to have you, Alex, here. How can startups balance between conversional marketing and authentic communication?
Yeah, so first of all, thanks for having me. Nice to see you all again in this formula. So I don't know, when it comes to having like aggressive marketing and more authentic communication, I don't think necessarily that when it comes to investment campaigns that they exclude each other. I think it's rather, and I like that Robbin really pointed this out, it's one before the other. So the first step is to actually validate your authenticity in what you're doing in your investment round, and that also goes to marketing. And once you do that and you check out all the boxes on trust, you can actually start pushing more aggressively than you would do normally. And I think this is more valid in investment campaigns and campaigns around fundraising than in traditional marketing campaigns, because of course there's a lot more at stake at the transaction, and everyone knows that that trust factor is much more important here. And of course, if you have this one big incredible fact about your startup, why wouldn't you promote it aggressively? Why wouldn't you spill the beans on it, let's say? But of course, aggressive does not mean dishonest. I mean, I want to make that clear. You can be aggressive in your tactics, in your approach, and how frequently you're targeting your audience, but you must maintain honesty, I think, at all steps. And of course, aggressive can mean promoting too early. So promoting without building that trust. And I've seen this backfire, because when you don't have that trust checkbox checked out, aggressive can come up as just being try hard, or even losing credibility. And yeah, we've all seen that happening. So that, I think that's the way you balance aggressive and authentic. First, you make sure that you built the authentic communication, that you have provable facts, and then if you have that in your investor's mind, not just on paper, you can actually go all in.
Definitely. Trust is an understatement, so but thank you for pointing it out. Since you've seen so many things, what are some innovative marketing strategies that have worked for startups? Because I know that you have a lot of experience on this.
I think there's a lot to talk about here. We could do a
But
whole
definitely.
day workshop just on this, on the modern marketing. And we're actually starting to call the digital marketing, like the paid ads and everything you have in the digital marketing, we're starting to call it traditional right now, because there's so much new stuff coming into marketing. And if I were to point something out, I really have seen a lot of cool examples, not necessarily from our side, but from actual founders and teams in automating outreach. So I think when it comes to innovation, I think that's where I saw the craziest of things done. Because I think one reason is because there's so many tools available for prospecting, for workflows, like big name tools, but also small products that just do a certain use case very well. And I've seen even founders directly, so not necessarily marketing teams, founders build crazy use cases. Like I've seen this once where they were prospecting from multiple areas like Crunchbase and LinkedIn. They were following those profiles on LinkedIn to see when they were posting, so investor profiles when they were posting. And when they posted, that started an automation workflow in which they took that content, they scraped it, they built a personal message with that content, and actually their investment opportunity, and launched an email to that prospect. I've seen these crazy use cases done, and they work, and they actually can work. I think it's really important that, and I've also seen the mistakes on these use cases, that you do have a control level, because of course, if you don't have that kind of innovation synced with your historical data, with your CRM, it can really backfire. It can come off as spammy, first of all, even though it's personalized, or even worse, it can be a mistake. You can send it to someone you know. And yeah, it does need the level of control, I think. And
You
yeah,
opened up the taste for a dedicated webinar on this type of experimental, innovative marketing ideas. Okay, thank you. How should startups incorporate feedback in their communication strategy? Because I think that this is an ongoing process that everyone should take seriously.
Yeah, I think I don't know. We're living in an age of product-led growth. So when we're saying startup, we're saying product, and a big part of product-led growth is to actually listen to your users, talk to them, proactively talk to them, gather feedback. And I think the most fundamental way to incorporate feedback is actually at the product level. Improving the product, continuously evolving it with users' feedback. And I think that this does reach, because we're talking about communication strategies, this does reach your communication strategy, because when investors see that you're doing this, and even if you go all in with like a build in public type of approach, when investors see you doing this, it shows that you have a strong team, very confident, a strong product, and you're actually building it faster than your competitors, which are probably stuck in a boardroom brainstorming ideas. So when you are building with that user feedback and doing it quickly and in public, I think that actually becomes part of your communication strategy. And maybe this is something that's more fundamental, bare bones, something that's simpler, and it's simple for every startup, is actually just getting good testimonials and quotes from important decision makers, this can actually help cement trust. And lacking it, though may seem trivial, can actually leave a lot of open questions on the table.
Definitely, yeah. What are your top 3 most effective communication strategies?
When it comes to investment rounds, right?
Yes.
Yeah, okay. I don't know. There's like everything in marketing. There is no silver bullet. There is no one size fits all. But there are some things that I've been surprised to see in investment campaigns. I think the biggest surprise I ever had was PR. I'm not a big PR guy. I don't do a lot of PR, and PR generally, yeah, it's straightforward, and you should definitely have it. But in investment rounds, it's not only serving the objective to inform, which PR generally does, but actually to build that, we all know it, that big fear of missing out in investors' minds. And when you look at PR that way, when you look at it, not just traditional PR, but also a bit of hype marketing, hype PR, promoting exclusivity, scarcity on a big opportunity, I think that's when it becomes really strong. And not only in the awareness phase, so not only letting people know that you have an opportunity, but also for those that also already considering seeing some new big news, some new big numbers, your startup would actually push the needle. That was the biggest surprise for me. I didn't expect it to work that way, but did see it in action. Again, I'll go back to direct outreach. I think it's really important. And the most important thing is to actually be treated like a marketing function. So yeah, of course, founders do it. Of course, you'll also always have business development people doing it. But prospecting, automation, CRM, multi-channel communication, tracking analytics, those are all marketing words. So it should be in the responsibility of marketing as much as possible and work together with the team, because you do it as a founder, but with modern marketing, it's 100 times more powerful. So yeah, I think those would be two of them, and I would just add community, and community means anything for every different startup. We can have a lot of conversation around community, but I don't know, turning users into ambassadors and actually nurturing those relationships long term can prove very, very effective.
Thank you, Alex. I definitely resonate with your top 3, especially with the PR. But I was not so surprised because I actually saw a lot of fundraisings, and I know that it really, really works to convert those who are interested, but also attract new investors, definitely. Thank you so much, all of you. I think that we can switch to the Q&A part. So I would like to follow up and encourage everyone who's on the other side of the screen to address questions. We already have one from Daniel. Excel versus CRM, top growth managers and consultants recommend not using robust analytics platform and to do your tracking and analytics as minor as you can to force you to think end to end. You can invest in your tech stack only after you reach a certain stage. Also, I believe it will make you more accountable rather than just passing it to your CRM. Eoin, I think this is for you.
Yeah. No, and I don't disagree with that to an extent. I don't see what the disadvantage of having both though is. Anyone that's worth their salt in terms of growth marketing, and I think Alex will probably agree with me on this, is that it's very hard when you get to scale that you can do that manually. So you do need to have some level of like AI or analytical tools, whether you're using Google Analytics or whether you're using, a multitude of different tools. That's going to help you bring everything together and again paint that picture. I think the point you're trying to make here, Daniel, is like you need to understand what your customer is doing, and that's exactly what I mean as well. The more information you have, the more you can actually see that end to end is a really big positive, because that's exactly my point. You're painting this beautiful picture to show to your investors and to understand your customers better so that you can tell a better story. I would be a big believer in doing both. So any companies that I've ran or any companies I've founded or consulted on, I will do both consistently. I will look at the data and go through it in a fine tooth and or go through it in a fine detail from a manual perspective. But I have all of the back end analytics working anyway for those different tech stack tools that I'm using, because it is physically impossible for me to do that much analytics and that much research without actually having the use of other tools to do it for me. But you still need to understand it end to end, 100%.
Definitely. And
Alex,
I
so you might have anything to add to that.
Yeah, I actually have some cool examples for Daniel. I've actually had this conundrum myself. Like, why do we need a CRM? We're just starting out. We're just figuring out what we're doing. We have a website. We're sending traffic to the website, but we're not doing a lot with it. But actually, we did take the decision to get a CRM, even a free version, just to be able to collect data historically. So we could just leave it there in the background for 6 months, not use it at all, but that data collected in those 6 months was invaluable for what we did afterwards. So just the idea of being able to have that data and deciding not to could be a bit of a handicap. So I would definitely push for, if you can set up a tracking point on any marketing touch point, and it can stay in the background without any big costs or efforts, you should do it in modern marketing, because it might turn up valuable sometimes down the line.
definitely. Thank you. Robbin, do you want to add anything?
Well, I'm not, let's say, the biggest growth marketeer amongst the three of us, I would say. So I'm more, I used my own, let's say, tactics for that. But what I do see is also from, let's say, setting up my own funnels and making sure that everything was there, is that if you don't use the systems and you just, if you look into the question of Danielle, you use Excel, things fall through the cracks. You're just not able to oversee everything. So apart from the fact that you're backing up your activities with data and you can analyze on it, it will also structure your daily approach. So you can actually, if you're really reaching out to large target groups, make sure that there are no people falling through the cracks, because there needs to be discipline, of course, because there's no system who's going to be your virtual assistant and going to help you with everything. So it all lives on the input and the data you put into these systems, and you need to consistently update and you need to consistently make sure that everything is there. But then it really helps you, and it's some sort of an external part of your mind, so you can drop things there and it will remind you at the point it becomes relevant again. And if you don't do that, then I think you're missing out.
Definitely. Thank you. Joris is asking us, what was a key moment in your own fundraising when you guys were a startup? What was the turnover point to survive the first phase? I'm not sure that our guests have ever fundraised.
Well, I did, but
I did as well.
for the Simbit time, I would say, because of course we started with Simbit, and then I think that answering the question for Joris is difficult, specifically because we did quite some funding rounds with Simbit, like a pre-seed funding round with some friends, family, fools, an angel round. With Simbit, we even went public in the States, so we had a public listing in New York. So key moments in the fundraising were always, for us at least, when I look back, is that we were trying to be disruptive, trying to tackle an industry from a really innovative, let's say, thought and let's say also planning. So we never, let's say, did something easy, or we were knowing what we were going to do. We were going to disrupt. So we had this BHAG, right? This big, outrageous, hairy goal. That's what we tried to make visible, and then set the baby steps towards that, and make sure that the investors knew, like, okay, we go big or we go home. So there's a chance of failure, but if we want to go big, these are the steps we need to take in order to get there. And that was a key point to keep people, let's say, at first informed, to get them in at first, then to keep them informed, and then the transparency on communication comes in again. So you really take them along the journey if things go differently as expected. And then you see some people falling off who don't do any follow-on rounds. You see other people who actually step up because they really like it and they believe in it. So I think that's the crucial part, let's say, there, at least from my end.
From my side, so I was the head of sales for an ed tech startup in Australia, and when we went through some seed funding rounds, and essentially we went through angel round and then we went through a seed round. So our angel round was, we had two angels that happened to be friends of the CEO, and we somehow managed to talk them into giving us a certain, or give the two of them giving us a certain amount of money, with a big, scary, lofty goal. So maybe some context in the business, we were essentially a career and an alumni tool, and content depository for universities. Super tough industry. Within 10 months, we had every university in Australia using our product bar one, and we had broken into 12 other countries. That made our seed round, if I'm being completely honest, super easy. Because we had a hypothesis, we backed it up with data, we could prove very clear ARR. So we actually didn't have to do a lot, because the two angels that we had did a huge amount of the promoting for us within their networks, which meant that when we went to our seed round, we had a huge amount of scarcity, because we were only giving away, we were honestly trying to keep it calm and not over, I suppose, and not over promise. But also in terms of, we didn't want to give away too much equity. So that became a lot easier. But to be brutally honest, it was purely down to, we had two really good people that understood what we were trying to do, and we under promised and we over delivered, and then it became so much easier for that funding round because we had this big idea and this big concept. So that's just my own personal experience. It's like, under promise, over deliver. All of a sudden, the next round becomes a hell of a lot easier.
Nice, thank you. Alex, do you also want to share?
Yeah, even though I'm not big on the founding teams of startups, I am very close to a lot of our partners. So we do have a story. We went with a client in an accelerator in San Francisco. This was exactly pre-pandemic, like 2019. So big Silicon Valley accelerator, investors demo day. We were pitching, we were fundraising actively, and pandemic hit. So pandemic hit like a month before our demo day. So everything in traditional fundraising space changed. There was a lot of fear. No one was interested in investment anymore. They weren't having the same conversations with us. Demo day wasn't happening the same way. So that's when the founder took. That was actually the turning point to survive. Was, okay, this won't be working. This is not working. What alternative do we have? So there were two big conclusions there. Okay, we go for another form of investing, and that's when we actually decided to go equity crowdfunding, because they had a big community, a lot of users, a lot of micro investors. We actually turned out very successful and actually focusing on revenue. So even this, like, okay, you have all these fundraising efforts and you're in a context that it's not working out for you, the founder actually decided to focus on revenue, and that was a big win for the company. It actually pulled us through another couple of months to go to the equity fundraising round. And I think that's a good lesson. So just judge your context and see what battles you can win. And I think that can actually turn things around.
Definitely. Thank you. And I think that's the way we got to meet each other, if I'm not wrong. Yes. Another question from Daniel. What's your take on investing in no-code startups? And I think Alex can also answer this one. Yes, they won't take over the world and there won't be any big exits, but most of them are crazily profitable, easier to build and grow. And most VCs' money will go into the actual growth marketing, not just in paying 5K per month per developers.
I have a take. It won't be an investor take because I don't have an investor perspective on it. But I do see a big surge from a marketer's point of view in no-code products. I think that they do have a lot of potential in this new paradigm of investing, where investors are looking more at revenues, at actual traction you can prove, and definitely no-code startups can get faster to that, because they require less setup. They are actually very focused on revenue. A lot of no-code founders are, okay, if this doesn't work, I'll just try something else. They just scrape and try other ideas. And this can be good in this new paradigm of revenue investing. So smaller multipliers, we need to see revenue. We're not okay with just seeing active users. We want to see revenue. But there is a big but. There's a no-code startup is more dispensable, let's say, because you have invested less in it. You're less emotionally attached to it. I've seen founders like just give up on their no-code startup, even though they were doing revenue, they didn't be able to scale, they weren't able to do a lot, they just left it there. And that for an investor, seeing that you're not putting in more effort to scale it and you're just focusing on something else, I think can be, because a lot of no-code startups that, I don't know if we're referring to the same kind of area, but a lot of what I see is very small products, single use case, isolated use case. It does it well, it makes money with it, but yeah, it's not going to be a visionary product. Most cases.
Mm-hmm. Robbin, any thoughts on this?
Yeah, I think I fully agree on what you're telling. And what I usually state is that if there's like a startup really working no code, then I do have a couple of examples where actually the platforms who were facilitating the no code software actually did some in-kind investment into the companies which use their no code platform. So they actually helped them with a little bit of, let's say, low code. So I know a couple of founders here from Rotterdam who have these low code platforms or no code platforms, and they actually decided to do some help, let's say. And with that, they got themselves a little bit equity and also had an operational role in there. And there I did find a couple of cool examples where there was also some commitment from the, let's name it CTO or technical level. So that could work. But yeah, in general, it's more difficult because you're not building something which is fully your own. It's replicable, it's less robust, and you're dependent on somebody else. And that's, I think, the biggest risk, that if somebody else is choosing to change, let's say, the way they structured their no-code platform which you are using, this is going to affect your business from the get-go. And yeah, that can be it can be a risk. So you need to be aware of it. And that's probably also what investors think.
Thank you. I hope that we answered Daniel's questions. If there are no other questions, although I think that we can wait 1 or 2 more minutes, I would like to wrap things up with a few things that I noted and I took from you. Special thanks for you because you make this really engaging and insightful. And I love every webinar because I feel that we go home with a lot of food for thought. What stick to me was, for example, to be rational as a founder and share the struggles as well, because that's very important and much appreciated by investors. To nurture an open line of communication. To use insights, to know the data points, not to think about them. This was really, really interesting from Eoin. To have a central source of truth, no matter the stage that you are at as a founder. To validate authenticity and then push more aggressively afterwards. So build trust first and then push it and scale it. Obviously maintain honesty at all steps. That's something that I think it's obvious, but wouldn't hurt to underline it. And then the PR side, that it can build a lot of hype and it can not only inform but also create a fear of missing out, which I think it's extremely important in a fundraising, especially for founders. So I think that's the summary in a nutshell. But we will get back with an official one, let's say so. And also we will be sharing a white paper that we've created. Let me see if we have another question. Yes. So we will get back with a white paper with the proven communication actions that we've seen that work for investor conversion via email, and I hope that you will like it. It covers a lot more than we managed in this hour, but I know for sure that would make the difference in fundraisings ahead. Joris is back with another question. Which decision was the most painful in the first stage of your company? Do you regret any of your decisions in fundraising, equity, stock, working together with investors? What do you recommend? A lot of questions, so let's take them one by one. Which decision was the most painful in the first stage of your company?
Hey, I can go with this straight away. I spent too much money on ads.
Too much money on ads, okay.
As a
But you were
I
testing the
literally,
hypothesis?
I think one
Or...
of my second startup. So I had an exit when I was 22, and then I had a second startup when I was a little bit longer, a little bit older. I had lots of money. I spent it all on ads, and I got very little return on investment from it. And it was arguably the worst business decision I've ever made. And that's me personally, just from a my own personal experience. Um, in terms of decisions from fundraising or equity or stock or working together, again, I'll have another example. I had a co-founder that we didn't particularly get on very well. And we were very good friends, but terrible to work with each other. Now we still have a friendship, but we were very close to losing that because we just didn't really get on personally in a work environment. So two thoughts on that is think about your return on investment from ad spend or whatever you're spending your money on. Make sure there's a very clear route to return on investment from it. Don't just pile money into it and hope for the best. And the second one is just make sure the person that you're working with or the investors that you choose, because remember, you choose the investors too. Make sure that they're at a point where you could my maybe I'm Irish and my surname is McGuinness, but can I sit and have a pint of Guinness with that person? Could I have a chat with them? Will I like to have a conversation with them? And that's my benchmark a lot of the time.
Mm-hmm. Definitely. Robbin, can you also share some? These are the spicy.
Yeah, well, what would we regret? Yeah, well, let's say in hindsight, I regret the fact that when we are looking back at the Symbit history, so the first platform we did set up, we chose to go public. And there's a lot of lessons learned there. So we went public on the OTC. We did a reverse merger. So we bought a shell company, and with that company, we listed, let's say, our own Dutch private limited company. And let's say the regret I have here is that it's fucking expensive at first. So that's maybe something you need to realize if you're doing this, because reporting on a stock exchange is it's a different ball game, because you're compliant to a fully different, let's say, legal and regulatory framework. And for us, it was also because we did choose to list that back then in the States. So it was a listing in New York. So we needed to switch to US GAAP on accounting level. So this meant that we needed to hire a different CFO, which is part of the expensive package I just told you about. And I think it's all really nice if it is the right moment and it's giving you, let's say, the infrastructure to really scale and to make sure that that you can actually pave the way for future growth. But for us, it was a little bit of a more strategical move back then to do so. And it wasn't we were not on the urge of, let's say, really going big in the States, but we wanted to be present there with an entity in order to go into the States at the moment when it would open up that market. And that actually took longer. So then being public, having your stock listed, then every fart you are shooting is public news. So you need to be aware of that. And I think that's also for all of the founders here and all of the founders who are thinking about this big and nice IPOs. Really make sure you're open to do that and try to talk to somebody who did it before and try to know what it brings, because you're under a loop and everything you do will be public info. So people can write about it without you sharing info. And this is not always negative, because in the end it can bring a lot of positive things as well. But yeah, it was a learning.
Maybe you've seen already Yuri's comment in the Q&A section. Funny. Alex?
Yeah, now I see. Yeah.
I'll answer on two sides here. One is a startup founder, one is as a service company founder. I think both have some lessons. As a startup founder, the most painful decision was to actually kill off the business. It is painful, but sometimes you must do it. I mean, if you realize that it's not going the way you hoped or your co-founders hoped, it is the most painful decision I think you can make, even more painful than kicking out the co-founder or something like that. But it is sometimes the best one, because I've also seen it more painful when you don't do it in due time, and it generates a lot of pain long term. And we also did one as a services company that I think applies to startups too. In the early stages, we consciously decided to be everything for everyone, so the all-in-one positioning. And I think looking back, we would have done much better by finding our specific use case, finding our specific market fit in the early stages. And of course, this is something that we see a lot of product companies fail at too, trying to be the all-in-one positioning when you just launched the MVP of your product.
Definitely. So I see a pattern of maybe timing or hurrying things up between your answers. Thank you, Joris, again for this one. I think we can wrap it up. Thank you all for making it so down to earth, so friendly, so I don't know, informal yet business. I really like this tone because I think that it's very helpful. We are just like everyone else. And you make it very easygoing. So thank you, guys. And see you at the next one. Bye-bye. Have a great night.
Thanks, guys. Have a great day.
Bye.
Bye.